So as Dr. Palmer said, I'm Max and this is Valentina. So we'll be talking today about financial statement analysis. We're going to take a more in-depth look at what we spoke about last week. We're also kind of touching back on some things that are important for you guys to be able to best pick your stocks and you know, have the most relevant information to help you guys really make the best informed decisions. Thank you very much. So this is some of the stuff we'll be looking at today, just to give you guys a visual idea, but we'll dive into all of them and break it down. And if at any point you have any questions about any words, please feel free to ask. Thank you. So when we evaluate a company's performance, when we decide if we're going to invest in them or if we feel it's a bad decision, we have to have all the right information to be able to make that decision. So we look at financial statements to really get a big picture of what the company is doing. As we spoke about last week, there are three different types of financial statements. You have your balance sheet, your income statement, and your statement of cash flows. So once you have a good idea of what those are and how to evaluate them, you can get a really good idea of if this is a good investment for you, your sector, and so on. So just a little refresher, I know we spoke about this last week, but it's super important to have this stuff down just because it'll give you the best information. So our balance sheet is a great snapshot. It really provides you a great context of what's going on in the company. It has all assets and liabilities. Does anyone remember what an asset was?
Things that they own.
Yeah. Can you give me an example?
Like you could use like equipment or such.
Exactly. And then we have liability, and that also includes cash. Then we have liabilities. So this is things that we owe. You know, you owe money. Perhaps, you know, you have to pay someone out, or you have a loan that you have to pay off. And finally, shareholder equity, which is, in the simplified term, really how much we own of the stock that we have issued. So secondly, a really important one is the income statement. The income statement allows us to understand the money that's being brought in, not just the money, but the actual revenue. This is super important, guys, because there are some companies that are super misleading. There might be a lot of cash coming in, but they're not able to turn a profit, which unfortunately ends up leading to bankruptcy for some companies. So we're able to see through the income statement how much money is actually being brought in and how much money they're spending getting that money. You know, it's important to know that maybe they're spending too much money getting customers, and that's why they're losing all this money. Finally, the statement of cash flows, which is a great tool to use to be able to see where is the money coming from, where is it going, is it coming out, is it coming in. This will have all cash information, and it's a great tool to really get a full idea of how the company is spending their money.
And something interesting too about the financial statements is you can just get on Google and look them up, like right now. And like Max said, they're super important. And Palmer also mentioned this, like if you can, as individuals, as investors, look at a financial statement, like an income statement, for example, and read it well and analyze it, then you have that much more knowledge over the next competitor that's also looking to invest and might pass over an opportunity that you have just discovered. So like Max said, it's really important to know and differentiate these terms like assets, liabilities, stockholders' equity, really like get those clear in your mind. It's like separate boxes.
Today, though, we're going to be focusing on the balance sheet. It's a really important financial statement, but especially for the stuff we'll be discussing today, you'll be able to find all the answers you're looking for on the balance sheet. Just wanted to give you guys a visual example. I know we'd gone over it last week, but this is not Manja, this is Domino's balance sheet, just a portion of it. We have all assets here, so this is like I guess you could say a positive side we're looking at right now. So we have everything broken down, and it's just important to understand that when you look at a balance sheet, you're getting a really great snapshot of what's going on. As you can see, we have inventory, equipment. You get a really good understanding of what the company is doing and how they're spending their money. And you know, at the end of the day, it's also important to understand that when we look at companies, you know, if they have a lot of stuff in inventory and stuff like that, that could be a big factor on if you invest or if you don't invest in that company. So just a little snapshot just to remind you guys of that.
Yeah, so now we're going to start looking at ratios, and this is exactly why you want to see like what type of assets you have in your income statement. So you have your earnings per share ratio, your debt equity ratio, and your beta, which we'll talk about later. It's not a ratio. So the first one we're going to look at is earnings per share. This will tell you how profitable a company is. You calculate this by dividing the net profit by the number of shares outstanding or the shares issued. That's what it means. So how many shares are currently in the market right now. And basically it's just telling you this is how profitable this company is on a per share basis. So we have this much net profit and these many shareholders, and this is how much each gets. It's like their piece of the pie.
Can you show me how to calculate that, Valentina?
Yeah, of course. So here we have Still Domino's. This is their statement of income, their income statement. And on this very bottom line, you can see net income. This is a calculation that you get from, adding up all your revenues, subtracting the cost of sales, and then you get net income. And then you have here on the balance sheet, you have your common stock shares outstanding is this number. So you just take the two and divide. Notice that up at the top, that one's in thousands, so it's something you also have to be very careful with income statements and general financial statements. But this is where they merge perfectly together. You use not one at a time, you use all three at the same time to get you this earnings per share. So we divided the net income by the shares outstanding, and we got $12.64 per share.
Now, why is it that you did that in the hundred millions and that was in hundred thousands? Just out of curiosity.
I'm sorry?
You see it says 491, 296,
Yeah.
and then you used
Oh, yeah, so-
just an example.
Yeah, no, so what we did, and the reason why is because these actual Excel sheets, when you download them, you can either get them in thousands and millions and whatnot, so probably when it was downloaded by the person that did the math on this slide, they probably downloaded a little bit longer of the line, and probably something like that. It's probably a rounding thing.
Because if Domino's only had $500,000 worth of revenue last year, I think that it would have a slight problem.
Yeah, I don't think that's an issue.
You got some more pizzas.
But that's a good thing to pay attention to. Those minuscule details will make or break your EPS ratio, for example. So what does this mean for investors? It's telling you how much one share gets you as an investor. It also tells you how company stock compares to others within the same industry. So for example, before when Max was talking about, we need ratios to compare companies within the same sector, their same line of business. Ratios do this really well because, again, this is a fraction. You're using a percentage. You're comparing apples to apples and oranges to oranges, and you're not having to convert anything. So this ratio is actually super handy and a great indicator of whether or not you want to invest in the company. And you'll see many more ratios in your lifetime, but EPS is definitely one that you want to remember and that you want to look for constantly. And not only that, but it also lets you know what the value of the stock is. So right now with Russia invading Ukraine, a lot of stocks are losing value because of everything else that's going on. So their earnings per share are diminishing.
Now, real quick question, Valentina, since you are an accountant, we can definitely always go to a table and we can find EPS.
Yes.
Why do we need to know all this other stuff? Because this is sort of bothersome to me. I'm a hardworking guy. I don't want to know how to do this. Why do we actually need to know the math? And why what is that?
Because it helps you understand what is deriving this equation and where you're getting these numbers. Since you're using two different financial statements to get the numbers, the net profit from the statement of income and the shares outstanding from the balance sheet, it helps you understand and gets a more holistic view of the company's profitability. Not only that, but you need to know how to calculate it, because if someone just gives you a number and you can't double check it because you don't know, you're putting your whole faith on someone who might have made a mistake, like this rounding issue that we had. So and also it helps you understand better why the company is either doing really well or could improve.
That's a good news.
So another ratio we're going to talk about is the debt equity ratio. A good thing I wanted to highlight that Valentina brought up, and I think it's important that we discuss just for a minute, is that when we compare ratios or any of this information, you guys will obviously be broken down in sectors. So it's important that when you look at this information, if you want to compare it, you compare it to companies that are in your sector, because one company's ratio might be completely, that's like saying, for example, let me give you an example, it's very easy, comparing LeBron James's free throw percentage to Sidney Crosby's shots on goal. It just doesn't make sense. So we want to make sure things are equal and we can understand them. So by getting companies alike like Apple and Microsoft, Ford and GM, you guys can really get a better understanding of where those numbers should be and if they fall within the regular market. So we're going to talk about debt equity ratio. So I think this is extremely important because this shows us how companies are able to manage their debt. Debt right now, for you guys is probably viewed as a very bad thing, but in reality for businesses it's a tool they use on a regular basis to be able to grow, fund a variety of different projects, And also, at the end of the day, if they're able to take out a loan and make more money in the period of time where their loan is repaid, they've made free money on money they were going to give away anyways. So it's a bonus for everyone. So when we look at debt equity ratio, what we're doing is we're taking total liabilities. So that is all the money that we owe, for example, like loans. That's an easy way to think about it. And then we're then dividing that by the total shareholders' equity. So to give you a great example, remind me your name one more time? Jack, okay. Let's say Jack owns a company that sells bikes, all right? And he makes $100,000 a year selling bikes, right? And let's say every year he's got $50,000 in liabilities, right? So we would take the $50,000 and we would divide that by 100 minus 50, so 50. So his ratio would be 1. So every dollar of debt that is spent, there's $1 of his as well, his equity. That's the best way to think about it, at least in my opinion. So it's really important to understand this and see this ratio because it shows you, one, how much the company is using debt as an instrument to perhaps pay for things, and that could be a big worry if they have too much, and also how much money of their own that they're putting in. So it's a great, it's a great visual, it's a great tool to be able to get a really big idea of what's going on. So we'll talk about leverage. So a great example that we'll use, and something you guys have probably heard, is mortgages, right? So if I can give a quick 30-second recap, but just a quick explanation, and to give you guys a better understanding of why using debt can be so useful. So if we all wanted to buy a house together for $100, we'll just make an easy number so that everyone can understand. We'd say maybe I don't have that money right now, so you pay a small amount, and then over 10, 20, 30 years, you're gonna pay the rest, right? We are leveraging our debt, the money that the bank is lending us, to be able to afford the home, right? So we don't necessarily have all that money right now, but we're using the money the bank has given us to leverage the rest of what we have to be able to afford the home, right? This is really useful, guys. Like I mentioned before, if you're able to make more money than you're gonna owe over that period of time, it's very beneficial for you to take out debt because you're essentially making free money that was gonna go out the window anyways. So taking out big loans for a long period of time, it's very beneficial for some companies, and that's why they do it. So it's not always, debt is not always the worst thing.
Sort of interesting too, because you're from Canada, right?
I am from Canada.
Now, do they deal with house mortgages and interest different in Canada than they do in the United States?
Yes, they do. There is, depending on the countries you look at, especially the companies you guys are looking at, they're going to be based everywhere around the world. It's important to understand that different countries do things a little bit differently as well. The United States has a very unique system, I'd say, compared to some other countries, and every country is different. So it's also important that you do some research into where your company is based out of. Maybe your numbers aren't significant with the competitors because they're based in a market where their interest rates are super low or super high, so maybe they're not taking out loans at the moment.
So, for instance, in the United States, we actually allow you to deduct on taxes. Tell everyone what a deduction is, since you're an accountant.
Basically, it's the end of the year, it's April 15th for tax season, at least that's the end of the year, you have to pay your taxes. If you made certain payments during the year, like for example for house mortgages and like the interest rates for that, the government actually allows you to take a little bit of that out of the taxes that you would have had to pay. So you pay less. It's not a 1-to-1 ratio, but you pay like cents on the dollar. And for example, another way to highlight that, and the question for you, Max, financial leverage can be really good for big companies that have a lot of debt, but it might be a little bit different for like an individual or a small company, like a small business. So if there's so much incentive to have debt to make more money later on, why doesn't a small company just pay everything on a credit card?
So that's a great question, thank you. So there's a couple reasons for that, but one of the big things we have to understand, especially with smaller companies, right guys, is that they might not have the ability to pay off debt the same way that these massive companies do. So what happens is that if you're a small business and you take out a big loan, that's kind of looming over your head. It's always going to be in the back of your mind that you have to pay this off. And without the backing like some big company like Domino's has with a bunch of bankers and a bunch of analysts there to help them, it might be a very intimidating thing to, first of all, just get a loan, but second of all, to have that over your head at all times with the risk of you not being able to pay that loan, it's very risky. So for some people in the beginning, it's more strategic for them just to pay what they can and figure that out later when they have enough cash to take out loans and do that type of stuff. Yeah.
Yes, definitely, and a super cool like case study if you want to look at it that way. If that was interesting, look at the 2008 housing bubble crisis. Look at how even back then, huge companies that were thought to be like the Titanic, that they were unsinkable, failed. Like Lehman Brothers failed, went bankrupt. So it's something that if you want to learn more about financial leverage, that's a really good way to do it.
Okay, so some information that's needed to be able to calculate this stuff. Like Valentina mentioned, the great thing is that most of this stuff is, Googleable. I don't even know if that's a word. But the good thing about it, though, with you guys understanding where the math comes from is you can check it and really understand those numbers. Like I mentioned before, guys, especially for this point right here, it's important that you look at the sector that you're in and compare it to other companies that are in the same field, because for some industries, like, I don't know if anyone here is a big fan of like Tesla, for example, or Uber, or any of those type of, or any of those companies, they had massive amounts of debt in the beginning and were barely turning any profit or anything like that. So it would be very misleading to look at their financials and just look at it in that perspective. So it's important that you compare it to other similar companies. And especially when we talk about the debt equity ratio, we don't want that ratio to be too high up, right? Because that means that they're spending a lot of money that's not theirs in comparison to what they have. So we don't want to, find out that companies are spending millions of dollars, but at the end of the day, they're not contributing anything, because that's a big fear of, do they not have money? Are they not going to be able to pay off their loan? So it's a big thing to consider. And again, that's just reiterating my point of just, making sure that you are sticking within your sectors and really comparing them to companies that make the most amount of sense.
So it seems like to me that if I'm doing my market watch game,
Yep.
and let's say I'm looking at McDonald's, I really need to look up several companies
Yep.
at the same time, right, in the same sector.
For sure.
So that gives me the better idea. So if I just do a gun hunch and I think, well, McDonald's is a great company, if I have nothing to compare it against, it makes it sort of difficult,
Yep.
right, to figure it out.
And the great thing about websites like MarketWatch or any of those apps that you guys might use is 90% of the time they actually recommend companies that they will let you know, hey, people bought this company, they're also looking at this, and they also bought this. So it's a great way for you guys to see who are the competitors in this industry, as well. You can Google that, but just there's great tools out there so you guys can really understand what's going on within that exact industry.
It's the same way that you wouldn't choose a college without asking your peers what they thought of it, or without Googling recent news about, their professors, their accolades, their athletics, stuff like that. And also what Max was mentioning before was super important, how they'll tell you, hey, if you bought this company A, look at this company B, because it creates a more well-rounded portfolio, a better combination of different securities, like stocks, bonds, that are better together than when they're apart. So what is a stock's beta? Beta is what tells you, it's basically risk. And in one word, beta is risk. It's what tells you the value of a stock when it moves up and down in the actual market. So I'm going to talk about volatility in a little bit, but I'll introduce it now. Beta is the difference between the average, in a stock market of that stock when it moves up and down, when you see it, the stock market open and close. And beta, like we mentioned, risk is not great when you have a lot of it, but it can make good times really good when you take on a really big risk and it pays off in the long run. You can make a lot of money that way, or you can lose a lot of money that way. So just like debt makes good times good and bad times even worse, risk also has that kind of same effect. So actually, next slide.
Yes.
So where do you find a company's beta? You can do it one or two ways. There are actually probably even more ways you can do it, but two main ways. You can Google it, like we've mentioned before. It's really easy to find this online. Yahoo Finance is a great website. Or you can run a regression model. So Max and I actually did this for a class last semester.
Which class was that?
Gallagher.
Oh, yeah.
Econometrics.
Gallagher,
Yeah. But to run a regression model, basically you have to code it in a special program called R and actually do computer analytics and get a lot of points. So one of the recommendations actually for this project was to get as many data points as possible to get a better concept of R. Because when you have, let's say, I look at Domino stock every single day from now until the end of the year. I'm gonna have a better idea of what their riskiness is, rather than if I looked at them, okay, like on the first of every month or on the last day of every month. It's gonna be very different results. You know, like at the beginning, they might not have as many pizza orders, or they might have more actually because people get paid at the beginning. But towards the end, people are trying to save money, so they're not gonna buy as many. So I'm gonna get very different results.
Sorry.
So a beta greater than 1 suggests that the stock is more volatile than the broader market, and a beta less than 1 indicates that it's lower volatility. So obviously you would like a stock that has less than 1 because you want it to stay kind of constant. You want it to be, you know, sort of reliable. When you're in the stock market, like Palmer said, nothing's for sure. Don't take anything for granted. Tomorrow the CEO could embezzle funds and your stock just goes down the chute. But when you have a beta that's less than 1, it's less likely, and therefore the stock is safer. But it being safer, it also doesn't give as many returns or as high returns. So for example, treasury stock, which is what the government sells in order to pay off its own debts and its loans, that has a really, really low beta, but you get minimal returns. It's one of the most safe choices you can make going into the market. It's even considered a cash equivalent. So back when we were talking about the income statement, it's an asset. So, and the income statement lists assets in order of liquidity. So the most liquid assets are on top, like cash, stuff like that. And the treasury stock is right up there with cash. As you get further down the list, less liquid items like equipment or land, then it becomes harder to turn those assets into cash to make readily available to pay off debts. So that's why beta is really important, because if generally higher risk stocks will have less liquid assets, they'll have more debt, they'll be kind of precariously put in the market where they're not super stable all the time. So you can get more returns that way, but you have to decide, is it worth it?
So can you explain to me what a portfolio is and why you would want to look at, what is a portfolio of stocks and why is beta important for that?
So it's like think of it like a bag, like a trick-or-treat bag of multiple different things that you're buying. So it basically offsets systematic risk. It's the risk that we can avoid. That, say, for example, I buy Domino's because it's a fairly non-risky stock, but then I also buy something that's super risky. And so Domino's gains will offset the losses that I may have from the really risky stock. Generally, these are portfolios are run by hedge and fund managers, and the normal individual usually cannot get into that unless they get into hedges, but that's a different story.
So what you want to do, I guess, is that when you have a portfolio, and that's what you guys will be picking, you just won't be picking one stock, you might be picking several stocks. So you want to look at different betas depending upon what you're looking at, because there's different, so you're looking at systematic risk differently. So for instance, one, you guys covered correlations in any stat classes, yeah, correlation. So if it's cold, am I more or less likely to wear a coat? Okay, that's a correlation, right? It's not called, it gets cold, it doesn't cause me to wear a coat, but it's a correlator, right? So 1, 0, -1, they're all correlations. So if you're 1, it means that it's highly correlated with the market. We typically talk about, you guys are looking at the S&P 500, that's an index of stocks, so it's correlated. So that's what you're saying, if it's 1, that's a great place to be at in terms of saying, oh, well, it's not too risky, and I'm probably going to be okay on this. On the other hand, how old are you?
16.
You're 16. You might say, well, gee, I'm 16. I may want to actually get a riskier stock because if you're 16 and Palmer's 60, oh my God, Palmer's going to do you think Palmer's going to be looking for more or less risk than you?
Less risk.
Yeah, that's right. I'm old, man. My insurance policy is Ian. Ian has to make a lot of money for me. Well, so at your age, you might say, gee, I might be willing to take a stock with higher risk because I want the higher return, right? Likewise, if you're looking at what's negative correlated, it might be there's some stocks that basically move counter to the market. So you might want to say, oh, well, this is a great stock that I want to put in my portfolio because if the market goes sort of wacky, it helps me to lay it out. So once again, these are all great measures for you to sort of start thinking about, what do I want to get?
And something really important that you mentioned too is right now a stock might be super risky, but in the long run, it will be better for you, not only in your portfolio, but just like to own. So for example, like Max said, Tesla at the very beginning was super risky. It had a lot of debt. A lot of people doubted its mission, its purpose even. So a lot of investors missed out. The ones that took on that really high risk, in the long run, in the short run, they might have lost a lot of money. But in the long run, it was probably a much better move financially for them than just not getting it.
So, like Dr. Palmer and Valentina mentioned, a great thing that, when it comes to investing is really being able to understand what you're looking at and how important it is to really be able to compare companies and really understand why the information you're looking at is so valuable. So a great example, sorry, next slide if you don't mind. A great example and a really useful tool that I actually really like looking at is the common size balance sheet. So what the common size balance sheet does is it takes a bunch of numbers that maybe aren't that valuable to you as an individual investor looking at things, right? If tomorrow morning I was to look up how much cash Ford had, I don't really know how relevant that would be to my research because I don't know how much cash a car company should have on hand at any point in time. But what I would love to understand is how much of that one account, like cash assets, for example, how much of a percentage of that is that of total assets, right? So we never, just like we spoke about now, diversification, that's what we were just talking about, how we want to have a variety of stocks to offset if the market crashes tomorrow or a scandal comes out with a certain company. When we look at the common size balance sheet, to give you guys a really good example, if you want to flip to the next slide, when we first looked at balance sheets, we only saw this first section right here, right? Now we have the percentage of total assets. And why this is really great to see is what's happening is if we take cash and cash equivalents, like Valentina was just talking about, like treasury bonds, we take that number and we divide it by, we divide it by our total. And that gives us a percentage, right? And that is a great indicator because now we can kind of look at everything and say, are there any numbers here that don't really fit in? Is there one thing they're putting all their money into? And just like we spoke about, that could be very dangerous if they have like 40% of their money in inventory, let's say, for example, is that something that should be, if I compare it to another company, are they at 40% or are they at 6%? Who's wrong, who's right? So this is really important information because it allows you to get a better concept of how much this makes up other, your company, but also allows you to go back and compare it to other companies and see, these are very similar strategies. Maybe I don't want to invest in these two companies together because they're so similar that if something were to happen, they probably both go bankrupt, So a really great tool to understand why diversification is really important and also kind of allows you to see really how companies are deciding to spend their money and where it's going towards, Like Dr. Palmer mentioned before, which was a really great point, is when we do analysis and we look at a variety of different companies, it's important to really understand why these numbers are the way they are. And with percentages and really being able to give yourself a better idea of what's being said, you'll be able to make the most informed decisions, which is really what's key, is having the most amount of information to make the best type of decisions possible. So same thing here, I believe. So we're looking at liabilities. Now this is again really important because if liabilities, if total liabilities or let's say accounts payable, which is I owe money at some point, not right now, but at some point, if that makes up, let's say, 20% of our of total liabilities, we know that there's a lot of money that's going to have to be paid at some point that's going to be going out the door, right? So that might be a really big red flag. It's important, though, that we understand, like I mentioned, that, when we do compare these numbers, let's compare them to other numbers in the industry so we can get a good idea of, maybe this is just a relatively high debt, sector, like the car market or another high, just to understand a little bit what the industry is doing and kind of get a better picture of it. So, is that clear to everyone in terms of the percent? Yeah, go ahead.
I have a
please.
question just sort of on the sheet.
Sure.
Now, what do the higher than 100% sort of percentages mean? See there it says 62 around.
Yeah.
Just what does that represent?
That is which one, make sure.
Long-term debt.
Yeah, this is long-term liability.
They're just totaling up, basically, like, I think long-term liabilities, it's the whole, they're totaling all of these percentages up. So, it's hard to think of it, it's really easy to think of it as like a whole pie, like a pizza. You can't get more than 100%. In financial statements, you can, because you have to add all of these percentages up. But because they split it up into like current liabilities and long-term liabilities, that's why some of them are higher than 100%.
So they're using like different metrics and they add them all up basically.
Mm-hmm.
So if you want more pizza, you can become an accountant.
There you go.
Pie's gonna be always bigger.
Grow the pie, yeah.
How's that?
And a really great, just one second. And a really great thing, guys, is if you're looking at these financial statements and something doesn't make sense, like Valentina mentioned before, you can Google a lot of this information, and it's really helpful sometimes to just go back and look at these for fun. And even myself, sometimes I look at these sheets and there's some things I forget. So just always looking at them and kind of Googling that stuff and getting a base understanding will be super important and will help you guys in the long run, believe me.
And one more thing, sorry, one more time. It's just so important. When we're talking about, accounting and finance and the financial markets, we're always trying to make a better and more complete analysis, because it's not, even though the balance sheet is a snapshot of a point in time, the financial market is ever moving and ever changing. So you need to be able to make decisions with that big picture in mind. Accountants sometimes get too caught up in the details and the minuscule little things of life, and they miss certain things. So that's why we have to compare a number of years. So here we have 2019 and 2020, and we can see how it grew, how it shrunk, which ones. I was trying to find a really big gap, but there really is. Oh, there's one right here. 262 went down from 294. Why is that? Why is that important? And things like that will help you better evaluate if a company is, better for the long run, better for the short run, if they're worth even investing in at all. So things like that you have to also take into account.